comment on those because I've asked my ministers to go away and look at their current spending. I mean, I think we need to acknowledge the government spends around about $70 billion a year, so there's a lot of areas where we can nip and tuck a bit to take some waste out of the system. We've done a lot of that over the last 2 and a bit years, but we need to do better because in the end the government has to stop borrowing as much money. If we don't, quite frankly, New Zealand will be downgraded and interest rates will go up for all New Zealand consumers.
So what have you seen since the budget policy statement that's led to your announcement today? I mean, it was only December where the statement came out saying $1 billion.
Well, I think the first thing is we are acknowledging the international environment is changing, and I think we saw that when Standard & Poor's put New Zealand a negative outlook because of what was happening, particularly in Spain, which has a debt profile quite similar to ours. And secondly, over the summer break, we kicked the tyres on a few areas where we thought maybe there would be some savings. And I am confident that we can come back in some areas. We can campaign again on those, or at least tell New Zealanders what we're doing, because they'll be part of Budget 2011. But in the end, I think the public will respect us for taking the tough decisions, but the right decisions for New Zealand.
Is health and education ring fence though? I mean, can you say to New Zealanders that you won't touch the health budget, that you won't touch education money?
Yeah, for the most part, they are. I mean, they're going to consume the bulk of what will be the $800 or $900 million that we spend. If we can find some additional savings on top of that, we can be even more successful than we're talking about. That may give us more money to reprioritise, and that's been a device that we've used. We've reprioritised around about $4 billion worth of expenditure over the last couple of years anyway. But you can see, I mean, we are really increasing new spending by a fraction of what the previous government did. We know that's difficult, we know that puts pressure on the system. We've reduced the size of the core bureaucracy in Wellington, as I indicated in the speech. There will be more to come in the next few weeks detailing where other changes will happen there. We've got areas like welfare where we're looking at reform. We've got other areas where we're signalling change, and they're all structural changes that over time will hopefully release capital.
And you're looking at possibly selling to close to 50% of those power companies.
Yeah, so the plan here is to get some advice. Obviously, we'd need to meet those tests, but my expectation will be if we can meet those tests, and on the right advice, we'll be going into the 2011 campaign, campaigning to have a mixed ownership model, allowing New Zealand mums and dads to buy in up to 49% potentially of those 4 companies, and potentially reducing the stake we have in Air New Zealand, which is currently 75%, probably down to 51%. Now, that is a complex issue because we need to take advice on how we can ensure that mums and dads are at the front of the queue, how we can make sure that we maximise the return to the Crown. But to give you a bit of perspective on that, if we could do that with those 5 entities that we've discussed, if we can make some savings in terms of what we're looking at in the budget, and maybe with a little bit of upside, you're talking about somewhere in the order of $7 to $10 billion with less borrowing that the government had done.
So you're envisaging that you could free up to $10 billion from partial privatisations of those entities.
That's right. So we're growing the overall government balance sheet. That's actually increasing. What we're looking to do is change the mix. And that gives us some options. I mean, obviously we need to fund the assets that we're talking about acquiring, new roads, new schools or whatever. But it also gives us the option to put that capital into areas where we think the economy can go faster. Maybe irrigation in the South Island, for instance. Maybe some more money for Kiwibank. There might be some interesting ideas where we can use that to build the economy. So we're really saying to New Zealanders, look, mum and dad change the mix of their assets from time to time. Sometimes the car's a bit too big and they get a smaller one. We're looking to do a similar type of thing, but overall growing the size of New Zealand's balance sheet.
And how limit yourself on just those narrow power assets and any New Zealand? I mean, there are still a host of other ones that you could look at, and you do mention in there that you could look at.
Correct. So the preliminary viewpoint that we're taking is we want to take to the market those assets which we believe are mature and that would give a good return to New Zealand, that have stable businesses. Some of the other businesses that you might think of either need more work or need to change. All their assets really could be considerable growth opportunities. Take Solid Energy, for example. I mean, they're a company that if they could acquire more capital, and let's face it, the government's cash strapped, then they might be able to grow their business faster. Some of the other energy companies, for instance, have real technology around geothermal and the likes. They might be able to deploy that overseas. So it's about, again, building their asset base faster.
Do you think you could guarantee that the consumers of customers like those power companies wouldn't face higher prices as those investors seek returns on their dividends?
So I don't believe that they'll face higher power prices as a result of the mixed ownership model. And the reason I say that is the following. Firstly, in the 9 years that Labour were in office, power prices went up 72% and the government owned 100% of the assets. So what's driving up power prices are generation costs, inefficiency in those companies and lack of competition. We have worked to address all of those issues. We've reformed the electricity sector. There's strong regulatory control there. We're in a position where I believe we've reduced the generation cost increase through RMA reform. And I think these companies will be better run if they're not 100% owned. And I think if you go and have a look at them, are New Zealanders paying higher prices to travel on Air New Zealand because it's not 100% owned? I don't believe the answer to that is yes.
So is this going to have an impact on economic growth? Because that's your issue right now. And you've spoken in the past about coming out of 2010 recently. It doesn't look like we're doing that. Growth's the issue, isn't it? So much savings and investment, or do you link them?
Oh, they're intrinsically linked. So the reasons they're the following. Firstly, to grow, New Zealand needs capital. At the moment, the only place we're acquiring that capital is from foreigners. And we are severely at risk that they either won't lend to us or they charge us more for that. And we can't underestimate the Standard & Poor's they're saying they will downgrade New Zealand, therefore putting up the price of interest rates unless we get on top of debt. So that's the first thing that we're sitting on. The second thing is by, I believe, taking some of the measures I've indicated in my speech but not fully fleshed out, we have a more efficient New Zealand. Again, that will help. The third thing is if we borrow and invest, lastly, as I say, if we change that asset mix, you can potentially invest in areas that will create more jobs faster for the economy.
It's only wealthy New Zealanders that can really get involved in your plan today, because if you're on the bones of as a New Zealander, you're not going to have spare cash to be able to invest in a company you already thought that you had an investment in.
Okay, so firstly I'd reject that on the basis that you'll continue to have an investment of 51%. Secondly, if you look at the distribution of KiwiSaver accounts, and that's going to find a home for that $1.5 billion worth of investment plus every year, that distribution is actually very even across the income stream. So those KiwiSaver accounts at the moment are either going in cash, quite a lot of them are going overseas actually, because there aren't the investment opportunities here in New Zealand. So again, I believe will deepen the capital markets. That's likely to bring other private sector companies potentially onto the New Zealand capital markets. So I think New Zealand mums and dads absolutely have a chance to invest. We saw that when Contact was sold actually by a previous government. I think what New Zealanders don't want is they don't want a trade sale to a big foreign investor. We accept that, and that's not part of the
Will foreigners be able to buy any of those shares, or is that restricted? Say there's 49% of Meridian in private hands. I mean, is that only in New Zealand hands, or are foreigners able to buy it?
Okay, the foreigners will be able to buy, so it won't be restricted in so much that there'll be a Class A and B share like Air New Zealand. And the reason for that is that preliminary advice with that is it'll be quite a big discount. And actually, if a Kiwi mum and dad buys one of those shares, they actually want to make a capital gain at some point. They want the price to go up. But what I can say is firstly, the advice we're getting from Treasury is to make sure that the early initial opportunity to buy in is directed absolutely at Kiwi mums and dads. So they'll be at the front of the queue.
So you'd stagger the offering. You had a public offering that you'd stagger.
Well, again, there's lots of ways we can do that. For instance, there might be a discount to mums and dads, a more expensive price for foreign ones. That's the first thing. Secondly, we effectively build the book, if you like, so who gets those shares. I'd say those shares are likely to be oversubscribed, so we can again work on making sure that's the case. Again, you've got the New Zealand Super Fund, you've got ACC, you've got a lot of New Zealand investment that's looking for a home. I don't think the issue is about whether we can find New Zealand-based capital.
But those companies would obviously list on the NZX.
In retrospect,
talked about sort of lifting the national savings rate, but at this stage, really, the heavy lifting of that
That's right. So if you look at the change of ownership of an asset, by definition that doesn't lift national savings because it goes from somebody's cash potentially going into a company as opposed to changing the mix of national savings. But what it does do over time is it changes the number of initiatives. Firstly, potentially reduces the cost of capital. That means we can grow faster, lift national savings that way, invest in other areas, and I think grow efficiency in these companies. I mean, these are very successful companies, but they can be a lot more successful.
why have you kept Kiwi Bank out of that mix?
Yeah, so there's a couple of reasons there. I mean, firstly, one, I made a firm commitment around Kiwi Bank, but it's actually